Two conclusions emerge from the bank's analysis. First, gold and oil historically reduce risk and tail losses over 5+ years by hedging inflation shocks. Gold against fiscal and monetary credibility, and oil against supply disruptions. Second, a higher allocation to gold is recommended due to institutional risk and central bank demand.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning. I'm Vince Lanci. It's 7:35 on Friday. There's the home page. Today, this is the Gold Fix Market Rundown, by the way. Today, the topic is a bullion bank says gold over bonds for the next 5 years. Following the failure of U.S. bonds to hedge equity downside and rising borrowing costs, Goldman Sachs notes investors are reevaluating long-term portfolio hedges. Two conclusions emerge from their analysis. We'll get into that in a second after we do the markets. Here's the home page. 10-year yields are dead unchanged. The dollar is 99.53, up 20. The S&P 500 is 59.07, up a couple handles. VIX is 19.15, unchanged offered. Gold is 32.93, giving back most of yesterday's gains, down 24. Silver 33.13, down 16, but nice move yesterday. We're in the range. Copper 464 and change, up 2. WTI 61.93, up 68. Volatile but tight. Natural gas 322, down 2. Bitcoin up 300. PGM's down $5-6, depending on how you look at it. Gold, silver still going nowhere. And grains are mildly mixed, with soybean the only negative one. Chinese stocks are on my radar, so I'm just keeping an eye on that. A few days ago, we put out a report, an analysis of the US dollar, US Treasury market for founders. And in that was a preview of, I think, a significant Goldman report for the longer term, with implications all over the place. And we're going to be breaking that down in detail and sharing it with the premium subscribers over the weekend. So here's a quick preview of what they're talking about. Following the failure of U.S. bonds to hedge equity downside and rising borrowing costs, Goldman Sachs notes investors are reevaluating long-term portfolio hedges. Two conclusions emerge from the bank's analysis. First, gold and oil historically reduce risk and tail losses over 5+ years by hedging inflation shocks. Gold against fiscal and monetary credibility, bank defaults, too much deficit, and oil against supply disruptions. Second, a higher allocation to gold is recommended due to institutional risk and central bank demand. Quick digression. That's something that we've said. There's really only one kind of inflation, but there's two ways that it manifests in the market. Either oil goes up or gold goes up. Lately, it's been gold going up for everything, as oil's been diminished as a geopolitical hedge and gold's been ranked higher. But anyway, there's the founder's version. It's really, that post is really about the rudiments of our thesis on how the U.S. will solve its deficit problem, as it says there, as it pertains to weakening the U.S. dollar without manufacturing anything new. And embedded in that is the Goldman analysis. There are a lot of charts in this report, and, well, we'll comment on it in a second, but we see where this is headed, we think anyway. So for strategic hedging over long horizons, 5+ years, Goldman recommends the following. Go long and overweight gold to protect portfolios against shocks to U.S. institutional credibility, i.e. credit downgrades, things like that. Go long but underweight enhanced oil futures to protect against hard to predict tail negative oil supply shocks. If you're wondering what enhanced oil futures means, it means you're long oil and you're long puts and you're short calls. you're collaring oil. And it also means you're going to play the roll. So if the market's in backwardation, you're going to roll it. So there's pieces of this that we've seen over the years from them before coming back, and it's all pretty valid. Um, but the comment, I think, the second order comment is this report. It's excellent, right? It's all about back testing and statistical analysis and why things are different going forward. And we're seeing this pop up in multiple places, as we hinted to the founders in that report. Other banks are talking about you got to hedge your treasury risk. You got to hedge your dollar risk. You're long the treasuries, hedge the dollars. How are you going to do it? Short dollars, buy stocks, buy gold, buy commodities. All these things are happening. Now, it may seem like a thematic investment that's just an idea that they have. It's not, okay? Central banks are leading what's going on now, number one. And number two, banks are positioning their portfolio analysis to go after mainstream pensions now. They're going after the big money that says 60-40, 60-40. And now they're saying, no, maybe it's 60-20-20. Maybe it's 25-25, 25-25. Who knows? But this is a positioning that we saw begin about a year ago when the Swiss started recommending gold instead of sovereign bonds as a hedge for their own risk. So this is Western banks taking the lead on this now. Anyway, that was a comment. Here's the official comment. Anti-Goldilocks has gone mainstream. Wall Street is now shifting its stance, with firms beginning to recommend gold over bonds, validating what we've been saying for the past 3 years. They're right. But this is a long-term strategic shift, and we agree with the underlying analysis. The traditional 60-40 portfolio model is being redefined. Importantly, Goldman has been ahead of the curve on gold, probably one of the few bullion banks that called it right while other bullion banks were dealing with their short legacy positions. Good for them. Importantly, as I said, Goldman has been ahead of the curve on gold, and other banks are likely to follow them right now, urging pension funds and 401k holders to increase exposure. Now, while this may sound familiar to Goldfix readers, it's breaking news for much of the West portfolio managers. I had a conversation with one of our founders, a text conversation, and she's plugged into the RIA side. And we were talking about, is gold overbought? Do they know it? What are the RIAs doing? And she was like, look at this. And she sent me some insights. And the RIAs, which are the registered investment advisors, the people that recommend what people do, they're not talking about gold at all. Like the cult of neo-Keynesian monetary policy is really ingrained generationally. So when you see a chart that says gold is underowned, like one of those downward sloping charts, and you're like, okay, I'm tired of seeing that. It's true. Like I have empirical evidence from this founder. The gold goes up and they say, oh, gold's up. Where's NVIDIA? Like we're talking about the people that are supposed to be giving you the advice on how to hedge this. So when you see this report, you'll say, I knew that. I knew that. You're just way ahead of the curve. You're no longer getting information from people that are regurgitating. You're getting as close to the core as you can. So trust what you read here and in other alternative sources, because this is what's going on. Now, throwing water on it. That said, the easy gains are likely behind us. The old story of if a bank is telling you to do it, you don't want to do it. You know what? That's true. That's still true. But this is they're not going out there saying buy gold tomorrow. Actually, they're doing that as well. Another conversation. But they are saying that this is a 5-year trade. And As a trader, the contrarian in me says it's time to buy bonds. That's it. Moving on. This weekend, coming soon, HeartNet Flow Show video walkthrough. As we go through and drill down and try and figure out what the heck he's talking about. Goldman says gold, not bonds. We just discussed that. That's going to be coming out this weekend. And the Founders CFTC Sunday meeting discussion and more. A little vault there that AI drew for us. Kind of cool. All right, related post. Geopolitically, this is kind of significant, and no one's talking about it, of course. But Mavs, one of the guys who we work with, he's over in Asia, and he noticed that China has released its first ever national security white paper. And in it, basically they're saying, we're serious about national security. And there's a lot of analysis in there that he broke down, and we share that with you. You can see all the other posts there. Let's move on. Today's a big data day, Friday, May 30th. PCE, the Fed's preferred inflation indicator. Advanced U.S. trade balance, Chicago PMI, consumer sentiment for May. And then at 4:45, after she rolls out of bed, Mary Daly of the San Francisco Fed regales us with her deep insights. Anyway, let's do a final market check. I think the only chart you want to look at today is this one. This is gold's daily chart. Just look at the yellow lines. They're in the process of squeezing. They're going to squeeze and give us a signal to move the market, but we don't know where yet. But look at silver. I mean, it's a big deal. And by a big deal, I mean, it's telling you, be patient. And that's it. I'm Vince. Have a great weekend. Look for some stuff this weekend.
Well, thank you as always for watching this morning's Markets and Metals as we wrap up another week with our dear beloved Vince covering the markets. And you would think, geez, in a couple decades from now, people will be writing books about these things. Maybe you'll even end up writing a book about what's going on right now. Certainly fascinating events out there. So thanks for being with us all week here. And before we wrap up and head off into the weekend, just would like to thank Fortuna Mining, who is one of the companies that not only allows this channel to continue to exist and bring events every day, but also that has done quite well capturing the elevated gold price. And fortunately, they did have some news out this week where they had drill results at their Diamba Sud project in Senegal, where the highlights included 8.6 grams per ton over 13.6 meters. And they also had an intercept of 113 grams per ton gold over 6.4 meters. And a note here from Paul Whedon, Senior VP of Exploration, talks about how the work at Diamba Sud has continued to yield strong results, particularly from areas with limited historical drilling, and notably at the Southern Arc prospect where they got that 8.6 grams per ton intercept, and also a 9.3 grams per ton intercept over 11.8 meters. And I recorded a recap of these drill results the other day that walks you through all of that. And certainly if you're looking for leverage on a gold rally, that's why so many of us turn to the miners. And certainly in terms of a well-run company that so far, and I think there's reason to expect to believe, have to be careful how I say that legally, but in position to capture that. And anyway, to find out more about those recent drill results as you head off on your way to a fantastic weekend, well, that video is coming your way now.